Understanding GDP and Market Capitalization, a Beginner's Guide. When we talk about the stock market and the economy, two important terms often come up: Gross Domestic Product, GDP, and Market Capitalization, market cap. Let's break them down and understand their connection in simple terms. What is GDP? GDP, Gross Domestic Product, is the total value of all goods and services a country produces in a year. Think of it as the income of the entire country. For India, the current GDP is $3,763 billion, rupees 325,061 billion, and it has been growing at an annual rate of 6.86% over the past 8 years. This includes inflation, so it's not the real growth, but still shows economic expansion. What is market capitalization? Market capitalization is the total value of all the companies listed on the stock market. It's calculated by multiplying the price of each company's shares by the number of shares they have. For example, when you combine the value of all companies listed on the BSE Sensex, or NSE, you get India's total market cap. The ratio. Market cap to GDP. The market cap to GDP ratio is a simple way to check if the stock market is overvalued, undervalued, or fairly priced. Formula: market cap to GDP ratio, total market cap, divided by GDP, multiplied by 100. If this ratio is close to 100%, the market is fairly valued. If it's higher than 100%, the market might be overvalued. If it's below 100%, the market could be undervalued. Currently, India's market cap to GDP ratio is 114.49%, which suggests that the stock market is modestly overvalued. Why does this matter? A high ratio can mean that stocks are expensive and future returns might be lower. A lower ratio can indicate that stocks are cheap and there's room for growth. Historically, India's market cap to GDP ratio has ranged from 58.03% low to 139.36% high over the last 10 years. So today's value is somewhere in the middle. New method, including central bank assets. To improve accuracy, experts now include the total assets of the central bank in the calculation. This new ratio is 102.34%, also indicating modest overvaluation. Expected returns. Based on these ratios, the expected future annual return from the market is around 6.8%. If we use the new method, it's 6.7%. For dividend-focused investors, the INDE ETF offers a yield of 1.58%. In simple words, the market cap to GDP ratio is like a health check for the stock market. Right now, India's market is slightly on the expensive side, but still within a reasonable range. This helps investors decide if it's a good time to invest in stocks or mutual funds. Understanding these numbers can help you make smarter financial decisions.